Hi, Assalamualaikum. We are from AC220B5K. Firstly, I will introduce my team members, which are Siti SYAHIRA, Siti FATIMAH, AININ, SOFIYA, and AIDA KHADIJAH. My name is Siti SYAHIRA binti BASRI, and I will explain question 1A, B, and question 2M FAR620. Before answering question 1, I will first explain the percentage of controlling interest. Grade acquired big and excel, while big acquired good. To be precise, on 1st January 2018, Great Berhad acquired 75% of ordinary shares in Big Berhad. Thus, the percentage for parents is 75% and non-controlling interest is 25%. On 1st January 2020, Great Berhad acquired 60% of ordinary shares in Excel Berhad, and this led to the 60% for parents and 40% for NCI. However, on 1st January 2021, Great Berhad acquired another 20%, which makes the total percentage for parents is 80%, while NCI is 20%. On 1st January 2021, Big Berhad acquired 60 million out of 75 million of ordinary shares in Good Berhad. Since Great Berhad is not acquired directly, it falls under indirect acquisition. To get the indirect percentage, 75% times 80% equals to 60%, thus the NCI will be 40%. For question 1A, compute goodwill or bargain purchase on the acquisition of Big, Excel, and Good Berhad. For the calculation, the three companies above gain a net goodwill. For Big Berhad, the consideration transferred during the acquisition was 960 million, while NCI is the total of multiplication of NCI percentage and fair value of net asset amounted to 314.5 million. In calculating fair value of net asset, it must include the ordinary share 1,050 million, pre-retained profits 100 million, pre-asset revaluation reserve 108 million on date of acquisition. Thus, for Big Berhad, the consideration transferred together with NCI is 1,274.5 million minus FVNA will result in goodwill. However, it has been impaired 10% and the net goodwill is 14.85 million. While for Excel Berhad, the consideration transferred is 322.5 million and NCI is 196.8 million, gives a total of 519.3 million. Minus with the fair value of net asset of 492 million after calculated ordinary shares 300 million, pre-retained profits 170 million, asset revaluation reserve 72 million, and fair value adjustment for land that increased by 3 million. As a result, after deducting FVNA from total consideration and NCI, the goodwill is 27.3 million. The last one is Good Berhad. The total consideration transferred plus NCI is 205.12 million, while FVNA is 175.3 million. After calculating ordinary shares 90 million, pre-retained profit 59.7 million, asset revaluation reserve 24 million, and fair value adjustment that increased by 1.6 million. The deduction will result in goodwill of 29.82 million. For question 1B, calculate gain or losses arising from the second acquisition of shares in Excel Berhad. The consideration transferred for the issuance of new shares is 67.2 million. The FVNA is similar to question 1A for Excel Berhad. However, the FVNA for this question needs to be multiplied with 20%. Thus, the remaining balance between consideration transferred and FVNA will become the gain on the second acquisition, which is 31.68 million.
Assalamualaikum. My name is AIDA KHADIJAH and I will be presenting the consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2020 for Great Berhad. Firstly, revenues of Great Berhad, the holding, as well as Big Berhad, Excel Berhad, and Good Berhad, its subsidiaries, are added together. A total of RM60 million and RM30 million were then deducted as there was an intra-group transaction happening where Great Berhad sold goods to Big Berhad and Excel Berhad respectively. Secondly, the total cost of goods sold of the companies will be adjusted according to the intra-group transactions, which are the goods sold to Big Berhad and Excel Berhad for RM60 million and RM30 million respectively, as well as the unrealized profit of inventory amounting to RM5 million and RM2.5 million. The total gross profit from the cost of goods sold deducted from the revenue will amount to RM310.5 million. Next, the consolidated investment income of RM51 million will be adjusted by deducting the dividends from intra-groups. There will be a gain of disposal of PPE of RM4.5 million after adding the balance brought down from Great Berhad and Excel Berhad, and deducting profit of RM12 million from the machine sold from Great Berhad to Good Berhad, and profit of RM4.5 million after Excel Berhad disposed a motor vehicle to Big Berhad. The total consolidated expenses will be adjusted by deducting the debentures interest of RM3.6 million, the impairment of goodwill of Big Berhad of RM1.65 million that had been calculated previously will also be deducted. As More Berhad had been acquired as an associate during the year, the share profit of RM2.17 million will be added. After that, the impairment of RM0.2 million needs to be deducted. Since there were assets disposed intra-group, the depreciation of each asset will be added to the CSOPL. Depreciation of RM3 million and RM0.9 million for machinery and the motor vehicles respectively. The profit after tax from the gross profit after all the addition of income and deduction of expenses will be amounted to RM216.92 million. To get the profit after tax, all the taxation from the holding and its subsidiaries are added together and will be deducted from the profit before tax. The profit after tax of Great Berhad and its subsidiaries will be RM153.32 million. Again, on revaluation of RM24.7 million will be added to get the Great Berhad's total comprehensive income of RM178.02 million. Next, we move on to the profit after tax attributable to shareholders of all holding and the non-controlling interests. The calculation can be seen in Working 1, where unrealized profit, overstated depreciation, and preference dividend will be deducted from the subsidiary's profit after tax. Then, the profit due to equity shareholders will be apportioned to the percentage in which the NCI is holding in the company. The total of profit after tax attributable to NCI of RM43.77 million will then be deducted from the profit after tax to find the profit after tax attributable to shareholders of holdings, which is RM109.55 million. From that, the total comprehensive income attributable will also be calculated. For NCI, 40% times RM0.7 million gain on revaluation will be added to RM43.77 million profit after tax attributable to NCI, which amounts to RM44.05 million. Then, the total comprehensive income attributable to shareholders of holding can be found by deducting the total comprehensive income of NCI from the total comprehensive income, which will amount to RM178.02 million.
Next, question 1D is about consolidated statement of changes in equity for the year ended 31st December 2021 is shown here. As we can see, there are three columns comprises of group retained profit, group asset revaluation reserve, and non-controlling interest. For the balance brought forward, we obtain the amount from the working tool. The amount of NCI at the date of acquisition for the BNSL company we get from the goodwill in question A. For the retained profit and ARR of parent company, we have balance brought forward that wholly put in GRP and ARR column respectively. While for the excess post-retained profit, it need to be apportioned into GRP and NCI column based on percentage interest, while retained profit of Good Berhad will be net off with the pre-retained profit. Same goes with ARR of Big and Good Berhad. Then we total up each column and transfer to the consolidated statement of changes in equity. Next, the profit for the year we obtain from the consolidated statement of profit or loss at profit after tax attributable to. There also have changes in shareholding as Great Berhad makes second acquisition share in Excel Berhad. That amount is taken from the question B of gain or loss on second acquisition. A 70.12 million of acquisition of subsidiaries during the year is referred to NCI of Good Berhad. Next, the revaluation ARR Great Berhad need to be added with 60% of increase in revaluation of goods freehold land during the year and 40% to ARR NCI. The last one is dividend on ordinary share and preference share, which the amount get from the working tree. Holding company receives 75% ordinary dividend from Big Berhad, 80% from Excel Berhad, and 60% from Good Berhad. Holding company only have its preference dividend. Other than that, the balance of 25%, 20%, and 40% are the ordinary shares in Big Berhad, Excel Berhad, and Good Berhad respectively for NCI. The preference dividend in Big Berhad is 100% belong to NCI. Thus, this three total amount in consolidated statement of changes in equity will be transferred to the consolidated statement of financial position.
Consolidated statement of financial position as at 31st December 2021. We total up the figures, holding and subsidiary companies with plus minus adjustments to get the figures. Under non-current asset, we have property, plant, equipment. For adjustment, we plus 3 million ARR surplus on land of Excel Berhad, minus 12 million unrealized profit of machine, which is the intercompany transaction, and then we plus 3 million the depreciation on machine, minus 4.5 million the unrealized profit of motor vehicle, plus 0.9 million the depreciation on disposal of motor vehicle, plus 1.6 million pre-AR surplus on land for good Berhad, plus 0.7 million ARR surplus on land for good Berhad. And then we will get PPE 4395.8 million. Next, we have other investment 525 million, intangibles 333 million, goodwill 71.97 million, and investment in associates, which is the small Berhad, 46.97 million. For current assets, we have bank 444 million, receivables 390 million after deducting 60 million and 30 million for intercompany transaction. We have inventory 326.7 million after deducting 5 million and 2.5 million the intercompany transaction that must be eliminated, and plus 16.2 million cash in transit. Then total up non-current asset and current asset, we get total assets 6533.44 million. Moving on to equity, we have ordinary shares 2467.2 million, preference shares 300 million, group retained profit 683.57 million, group ERR 534.42 million, NCI 719.45 million. These three groups we obtained from working to schedule of reserve and NCI. For non-current liability, we have 8% debentures 855 million. For current liability, we have payables 709.2 million after deducting intercompany transaction, and also accruals we get 264.6 million. Therefore, the total equities and liabilities is 6533.44 million.
For question 2, I will explain on NEL, Shinji, and FNE Berhad in accordance with MFRS 10. The acquisition of FNE Berhad happens when NEL Berhad and Shinji Berhad acquire 50% of the shares respectively. This qualifies them to be the parent of FNE Berhad because both of them hold majority rights by acquiring more than half of the voting rights in the company. To determine the ultimate parent, both NEL Berhad and Shinji Berhad have to assess whether it has the practicability to direct the relevant activities unilaterally. As a result, only NEL Berhad fulfills the characteristic which have a power, exposure or rights to variable returns, and the ability to use its power since it has the existing rights and having the supervisory roles to monitor the project undertaken and getting approval from the board of directors. The activities made by NEL Berhad will have a significant impact on FNE Berhad's return. Other than having a voting right, NEL Berhad also has the right to appoint the senior management team members, which is responsible in making key decisions on the project that are important for the company. This shows that NEL Berhad has exercised its power toward FNE Berhad, while Shinji does not have control over FNE Berhad since it has no practicability to direct and does not fulfill the requirement of control. Hence, Shinji Berhad is not required to prepare consolidated financial statements due to lost control over FNE Berhad. According to the Companies Act 1965 and MFRS 10, the consolidated financial statement should be prepared by NEL Berhad since it is the parent company. This indicates that NEL Berhad should prepare two financial statements, which one is for its own entity and the other for the group. Hence, Shinji Berhad is not required to prepare consolidated financial statements due to lost control over FNE Berhad. According to the Companies Act 1965 and MFRS 10, the consolidated financial statement should be prepared by NEL Berhad since it is the parent company. This indicates that NEL Berhad should prepare two financial statements, which one is for its own entity and the other for the group.
Next, our opinion regarding MFRS 11 joint arrangement is NEL Berhad and Shinji Berhad are not involved in the joint arrangement because there is no contractual agreement between them to consult or make a collective decision. It means that there is no legal obligation for NEL Berhad to get consent from the Shinji Berhad. Thus, there is no joint control. Only NEL Berhad has control over FNE Berhad and can make decisions about the relevant activities.
On the date of acquisition, KHADIJAH Berhad has become a subsidiary to 100 Berhad. Hendrik Berhad has acquired 80% of Kendall Berhad's shares, 15 million units for RM27 million. There will be a reduction in Kendall Berhad's share capital on the date of acquisition. The balance of 20% is non-controlling interest. The consideration transferred of RM27 million will be added with non-controlling interest by using fair value, which is a full goodwill of RM4.5 million. It will be compared with fair value of net assets on the date of acquisition RM26 million, which consists of ordinary share capital, retained profit, general reserves, and asset revaluation reserves for surplus of land RM1.5 million. The goodwill is RM5.5 million. Then the goodwill will be deducted with impairment of goodwill of RM0.5 million, thus resulting in the net goodwill of RM4.7 million. The net goodwill will be recognized in the Consolidated Statement of Financial Position (CSOFP) under the non-current assets. On the same date, the surplus on revaluation of land will be recognized as asset revaluation reserve in Consolidated Statement of Changes in Equity and increase in property, plant and equipment. It will be accounted in under the non-current assets in Consolidated Statement of Financial Position by RM1.5 million. There is no depreciation for land as it is a non-depreciable asset. Non-controlling interest will be recorded in CSOCE and transferred to equity in CSOFP. The impairment of goodwill of RM0.8 million will be recorded under Hendrik Berhad in group schedule and recognized as an expense in Consolidated Statement of Profit or Loss and other comprehensive income, which will reduce the net profit of the company. The account of impairment on goodwill will be created and it must be recorded under CSOPL. The goodwill of RM4.7 million is recorded in the CSOFP.
Question B. We need to calculate the gain or loss on the disposal of the share for Hendrik Berhad. We get 26 million for sales proceeds, 10 million for fair value of remaining shares at 31st December 2020, then we get a total of 36 million. We minus the 36 million with fair value of net asset of Kendall Berhad, the subsidiary, at 30 June 2021 for 35 million. We multiply with 80% and we get 28 million. The 36 million we minus with 28 million minus with the remaining goodwill from question A, 4.7 million, we get a gain on disposal of 3.3 million. Question C. The effect of implementing the plan on the group's financial statements as at 31st December 2021. Hendrik Berhad has disposed 85% of its equity shareholding in Kendall Berhad, which make its ownership balance of 12%, where 80% minus 85% times 80. Kendall Berhad's status changed from a subsidiary to a simple investment as of 30 June 2021. After the disposal of shares, Hendrik Berhad has no control over Kendall Berhad because the interest held is only 12%, and it will be treated as a financial asset. Gain or loss on disposal will be offset against all remaining goodwill after deducting the impairment, and it will be recognized in the statement of profit or loss. For the following period, any dividend paid by Kendall Berhad also will be recognized in the statement of profit or loss. Kendall Berhad's assets and liabilities in the group's financial statements as at 31st December 2021 will not be consolidated because Kendall Berhad is no longer a subsidiary of Hendrik Berhad. The simple investment is recognized as an investment under non-current assets in Kendall Berhad.
Question 4 is about Planten Berhad purchased 26,000 ordinary shares out of 104,000 in Seni Berhad for 8.5 million on 1st April 2021. From this, we know that Planten Berhad has 25% interest in Seni Berhad. Therefore, Seni Berhad is an associate company because it fulfills the definition of investment in associate, which Planten Berhad holds between 20% to 50% of voting power and has the significant influence by having the rights by taking part in the policy-making process and interchange of managerial personnel of Seni Berhad. Apart from that, O&O company as a parent company need to prepare the equity method to measure the carrying amount of the net asset and disclose it as a separate item by reflecting its shares of the net asset